Then the C aspect said, discuss how, oh no, that's 5 marks. What we just did is 5 marks. So it's fair because, we are doing a lot of work. Then the C aspect said, discount how invoice discounting and factoring can aid in the management of trade receivables. So when it comes to trade receivables, there are 2 ways we can manage it. So this is a reading aspect. We can do invoice discounting or factoring. Now, what is the difference between the two? Invoice discounting means selling, literally, our trade receivables for an amount below the face value. So, like you owe me. Let's say you owe me $10,000. And per our agreement, you are supposed to pay me in 90 days' time. But I cannot wait 90 days' time. So I could go to a discounting house and then they can say that, okay, although the person owes you $10,000, guess what? I will pay you, or someone else, a third party will say they will pay me. That's the discounting house. They will pay me $7,280. Now, so that they will wait till the 90 days, then they can get the money from my supplier. So the difference between the face value and the discounted value will be the cost that I have to incur if I do invoice discounting. And then it will also be the profit to the third party or the discounting house. That's the idea there. That's the idea. So that's the concept of invoice discounting. Then debt factoring is more or less like outsourcing the management of our trade receivables to a third-party organization. So maybe we don't have a number of people, or many people are not paying us on time. Okay, so many of our customers are refusing to pay on time. Okay, since they are refusing to pay on time, but we need our money, let's bring in a third party. So what happens is that the factor comes in and we can arrange. We had debt factoring with recourse, debt factoring without recourse. Okay, so we are with recourse and then without recourse. With recourse means that the entity is liable for any amount that we are not able to recover. Okay, so the entity is still liable to any balance outstanding. In other words, under debt factoring with recourse, the entity bears any risk of unpayment. Okay? So the entity bears any risk of bad debt. That's the idea. Any risk of bad debt. But debt factoring without recourse, here, it is the factor that bears the risk. So the factor is liable to any balance outstanding. So the factor bears the risk for bad debt. Okay, so the factor bears the risk for bad debt. Now, there are some advantages here because when you outsource your trade receivables, it means there are certain costs you will no longer have to incur. Right? The management of that trade receivables, it may reduce how much bad debt you have to incur as an entity. That is also another benefit that may come in. But it will cost you because the factoring agent will charge you a fee. And on top of that, sometimes it depends on the way the deal is arranged. The factory agent may give you upfront money, like a loan, and you have to pay interest on that as well. So in making a decision whether to factor or not to factor, we will compare the benefits, that is the cost savings, if we are not managing receivables again, and the reduction in bad debt, to the cost that we have to incur if the factor agent comes in, and that will be the agency fee, and sometimes plus the loan, the interest we have to pay on the loan that they will give us upfront. Then certainly either with recourse or without recourse, then we will make the decision. If the net benefit exceeds, if the benefit exceeds the cost, then we factor. But if the benefit is less than the cost, then you don't factor, you continue to manage your own affairs. So when it comes to trade receivable management, these are the things we must understand. Invoice discounting, selling your inventories to get an amount below how much it's worth because you want the money right now. Factoring, outsourcing your receivables to a third-party entity so that third-party entity takes over the management of your receivables. These are the difference between the two. And so let's look at the debt factoring issue and see how the calculation works like. Okay, so still in this question kit, you go to, I think, question number 3. Yeah, here. On page 6. Question number 3 on page 6. Now, stay with me carefully here. So this question is about debt factoring. And the reason I jumped to that is because I want us to look at the factoring, the way the calculation works, because we said to determine whether we should factor or not to factor, we look at the difference between what is available, the benefit we will get, and the cost that we will incur. So let's look at it. A. Advise whether the factor or the factor's offer is financially acceptable to Window Co. Is it Window? Window, okay. Window Co. So let's see. Then B says briefly discuss how creditworthiness of a potential customer can be assessed. We'll come back to that. The finance director of Window Co. had been looking to improve the company's working capital management. Window Co. has revenue from credit sales of $26,750,000 per year. So this is the trade receivables. And although its terms of trade requires all credit to be settled within 40 days, so this is the current trade receivable days, 40. On average, customers have been taking longer. Approximately 1% of credit sales turn into bad debt, which are not recovered. Oh. So, current policy, 40 days. Bad debt, 1%. Trade receivable currently stands at this amount. And Window Co. has a cost of short-term financing of 5%. This is one thing you must understand. If our customers don't pay us on time, then where do we get money to pay for our operating expenses, pay our suppliers? You have to go borrow the money. Because we are talking about working capital management. So you have to go and borrow the money. The finance director is considering a proposal from a factoring company, Nhyira Co., which was invited to tender to manage the sales ledger for Window Co. on a with recourse basis. Okay? With recourse. So it means at the end of the day, the entity will still bear the risks for any bad debt. But that could be beneficial because when a third party is coming in, customers will take us serious a little bit and pay us as soon as possible. Nhyira Co. believes that it can use its expertise to reduce the average receivable days to 35 days. Okay, because currently we are doing 40 days. But the factor agent is saying that they will do same in 35 days. While cutting bad debt by 70%. Uh-oh. So currently we are doing 1% of the receivables going as bad debt. But they say they will cut that by 70%. We'll come back. Reducing the administrative cost by $50,000 per year. This is a cost savings for us. A condition of the factoring agent is that the company would also advance Winoco 80% of the value of the invoice raised at an interest rate of 7% per annum. Because nothing is free. Nokfe would charge an annual fee of this amount on the credit sales. Assume that there are 360 days in each year. Okay. So let's break it down. So our current receivables. So current trade receivables is, permit me to put dollar above here, is the 4458. So 4,458,000. That's our current receivables. Now, if the factor is going to come in, they said they would do 35. So let's bring in the receivables if the factor comes in. So revised trade receivables. And that is going to be the annual sales we do on credit, 26,750,000. 26,750,000. Multiply that by the 35 times 360. So you got to be careful here because they've given you the number of days. If the number of days are not given, then we can use the standard 365. But 360 is given here, so we stick to that. So 35 divided by 360 times 26,750,000. And that is 260 or 2,600,000, maybe 694. So if you check, by bringing in the factor, there is going to be a reduction in our receivables. So reduction in trade receivables. How much? 4,458, 123. 4,458, 123. Minus 2,600,000, 694. And that is 1,857,306. 1,857,306. So that is the reduction in our receivables. Okay. So if our receivables will reduce by this amount, then we no longer have to go and borrow money. So now let's look at the benefits of bringing in the factor. So the first benefit will be a reduction in our financing cost. So you don't have to go borrow this money from the bank at, what's the rate? 5% per annum. So our answer, 1857 306 times our interest. What's our interest? Yeah, 5%. So this will be reduced. So my answer by 0.05, 92,865. What other benefit we will have? The administrative cost of 50,000, we don't have to pay that again. $50,000. Then remember, they said by their presence, they will reduce our bad debt by 70%. So let's get a bad debt and then 70%. So reduction in bad debt. That's a benefit. It means more money you are getting. So your sales is 26,750,000. We are told that 1% of that goes into bad. So 1% of that would have been bad debt, but the factor says they will save us 70% of that. So times 70. 26,750, 123 by 0.01 by 0.7%. So we will save 187,250. So if the factor comes in, our financing is reducing because trade receivable is reducing by this amount. So this money is coming in from the debtors. Because it's coming in from the debtors, you no longer have to go to the bank to borrow money. So there is a reduction in your financing. Number two, because now the third-party organization is taking in charge or is in charge of your receivables, that administrative cost of 50,000, we are not the ones who are going to go after the debtors again. So we are saving that. Then the factor is saying that now your bad debt is 1%. When I come in, I'm going to save you 70% of that. So that is a benefit to us. So in the context of this question, these will be the benefits on the contract. So plus 50,000, 92,865, and that is 330,000. 115. So 330, 115. But what is the cost? Because this is the benefit of bringing in the factor or the factoring agent, NEFCON. So let's bring in the cost. So cost of the factoring agent. Two things. They say they will charge us a fee of what? Let me clean this so that we get the idea. NOCFECO will charge an annual fee of 0.75 on credit sales. So we bring in their fee. 26,750,000. They are taking 0.75% of that. That is not a significant amount of money, though. So we punch that out. 0.75. Wow, that's strange. So 0.75 divided by 100 times 26,750,123. And that is 200,000. Whoa, I was thinking it's not going to be money BL. 200,625. So 200,625. Now you got to be careful about this punching because it is 0.75%. So you got to be careful. Now, in addition to this, they will give us some money up front, which we have to pay them an interest. They said they will advance 80% of the money to us, but we have to pay them an interest of 7%. So that will come. So there will be an increase in our financing cost. %, of two, no, let me see. Of the receivables figure, which is 2,600,000. Give me a sec, let me read this thing well. Winscorco will advance 80% of the value of invoices raised. Okay. Value of invoices raised. So 2,600,000, which is the trade receivables now. 694. But you got to be careful. They are giving it to us at an interest rate of 7%. We would have got it at the bank at 5%. So the increment the extra payment. So this will be times into bracket 7% minus 5%. Okay? So it is the additional finance cost that we are thinking about. The additional finance cost that we are thinking about. So let's build it in. 0.8 by 2,600,000, 694 times 0.02, and that is 41,611. So at the end, the total cost of our agent is 200,625 plus 41,611. And that is 242,236. So if you check, bringing in the agent will cost us this amount, but the benefit we are getting is that amount. So the benefit exceeds the cost. So net benefit is going to be equal to 3,115 minus 242,236. So we punch that out. And that's a net benefit of 879. So that is our answer to the question. Now, should they accept it? Because the question said, advise whether the factors offer is financially acceptable to Windsor. So on the basis of this, the factors offer is financially acceptable. Okay? As the benefit exceeds the cost. So in other words, engage the factor. That's what we are saying here. In other words, engage the factor. Now, you got to be careful here because there are theory aspects of this whole discussion, and that is to look at the limitations of bringing in a factoring agent. Aside the financial issues, there are other issues, right? The reputation of the firm. I owe you. I'm doing business with you. Then all of a sudden, my phone will ring, or I'll get an email, or somebody will visit me at the business premises and say, hey, you owe this person. And so we are now the ones who are coming to collect the debt. I mean, it creates some discomfort. It's like, so you think I won't pay you or what? So it could result into loss of customers, as some people will feel that, they've been doing business with you. Now you are sort of selling them to another person to take over. So that is something that has to be understood there. But that is the context of our question. That's the answer there. Then the final part is the B aspect of the question. It says, briefly discuss how the credit worthiness of potential customers can be assessed. Now, there are various ways that we can assess credit worthiness of customers before we sell to them on credit. Certainly, you want reference. Okay? So, reference from their previous places of doing business. We'll be interested in that. Number two, we can also use credit rating agencies to assess the credit worthiness of a customer. So if the details of the customer is in the rating agency, then we can assess the risk profile of the customer in respect of that. So credit rating can be used in that regard. And normally this will be for large companies that we are looking at. Another thing will be press releases or industry reports. Press releases and or industry reports. That can also be used because the press releases and reports going on can give us an idea, give us a clue on exactly what is happening within the industry. So these are some of the ways that we can assess the credit worthiness of customers. And that is what you must understand when we talk about trade receivables management. So let me come back here for plot go, slide 1 there. And then slide 2. Slide 3. Slide 4. Slide 5. Slide 6. Then the receivables discussion. Then the last question on the management of the trade receivables. So under working capital, we've looked at inventories, we've looked at trade payables, and then the receivables management, the final slide. So 15 marks area. So we are left with, even under the inventory, there is one more thing left. That is the working capital, the cash operating cycle, okay, or the working capital cycle. Then we can go to the cash management, where we can use the cash issue, or we can use the Miller or model to determine how we can manage our cash. So that is it about that. I'm going to be wrapping up around here today, and then we will continue in our next session as we see the next few things we will get into. So in the next session, we'll look at some other issues still under the working capital, crystallizing the principles. Then we will jump on into the issue in respect of investment appraisal. Then I will come back in with some of those theory written areas in respect of PFA, and then public procurement as we continue with the discussion.